Hi, I'm Pattu from freefincal. Today, let's talk about a person's risk appetite. Often, you can see questions like, "What mutual fund should I choose if my risk appetite is moderate?" And just before starting this video, I saw a question on Reddit that said, "My risk appetite is low and I want products for that." Now, this is a serious problem, and the truth is that nobody knows what your risk appetite is, and it's a bit like asking a person who has never ran a marathon, who has never practiced for it, never trained for it, and you go and ask him, oh, okay, you're going to run your marathon, what percentage of that race would you complete? I mean, you don't know, nobody knows. And the truth is that we all know how we will react to a big loss or a big gain only after it occurs. And if that big loss occurs 1 year after investing, we will react in one fashion. If that big loss occurs 5 years later, 10 years later, we will react in a different fashion. So the whole concept of risk appetite and determining risk appetite is completely and utterly flawed. Now, I have been investing for the last 12 years. Many of you know it. I have never seen a huge market crash until March 2020. And even that crash, now when you look at it, it has recovered. Most of it is more or less recovered so fast that it feels like I have not gained any great experience from that crash. So I still feel I don't know what is my true risk appetite. I don't know what is my risk taking ability. I don't know. This is something that is going to be, I think, going to be tested. The good news is that we don't need to know. The good news is we can still manage our portfolio without worrying about what our risk appetite is. So, in my opinion, we should stop talking about risk appetite and start considering or working in terms of what I call as a risk quotient or an RQ. For example, if you ask your friends what return you would expect from your equity investments over the next 15 years, and if they just tell you some number like 10%, 20 or 15% or 12%, whatever it is, I would say their risk appetite is insufficient. Their risk awareness is insufficient to be successful in equity, because the how much ever you invest, the spread between the maximum possible return and minimum possible return in equity from your equity investments is just too wide, and you don't know what return you're going to get. And so the only way is for you to learn portfolio management, start investing enough by having low expectations. So you can ask this question, and there's a fact associated with a certain question about risk, and how close that person answers to that fact can be used to determine that risk quotient. For example, you can determine the risk quotient as inadequate, which means that the person has to learn basics. The risk quotient is amenable, which means that the person will listen to suggestions well and will be flexible. And you can say the risk quotient is superior, which means the person doesn't even need an advisor and they can start investing on their own. Now, people with the inadequate risk quotient should go back and invest. They should go back and start learning the basics and not worry about investing. So, this whole idea of risk appetite is seriously and heavily flawed. So what I would suggest is that before you start investing, learn to appreciate risk at least a little bit. As you invest, you will anyway learn new things, but to some extent you must be prepared from day one, is my humble suggestion. The problem is, I can start saying you can invest in index funds or aggressive hybrid funds or balanced advantage or dynamic asset, whatever it is, but for example, in this March 2020 crash, I have seen people complain, why are balanced advantage funds falling so much? They are supposed to be balanced and protect us from market crash. Why are dynamical asset allocations falling? Because if I say my fund has fallen by 20% compared to Nifty, which has fallen by 30%, that's a fact that the fund has fallen 10%. The quantitative number is very clear, but how I will interpret it will be different. Some people will say, okay, I have protected my investments up to 10%. Some people will say, anyway, this has fallen 20% now, so what's the big difference between this fund and Nifty? So people will react very, very differently. We don't know how people will react when actual money, their actual money is involved in the whole idea. So it's more or less the same thing as the conducting an exam. I've been saying this long many times. I've talked about it, I think, in a previous video. I also talk about this to my students. I tell my students, when an exam is conducted, the what is being judged is how systematically you have worked and satisfied the requirements of the system. We are not judging anybody's intelligence. Nobody can judge intelligence. And to graduate, a student should appreciate the needs of the system. What is necessary should be done. The same thing is applicable for investing. We don't know risk appetite. We can never judge risk appetite, but the investor should understand what is necessary for creating wealth in the future, for satisfying needs in the future, and that has to be basically complied with, and that is all that anybody can do. So my suggestion is, for long term goals, new investors should gradually start investing in equity. They can increase the equity exposure slowly, 5%, 10%. Look at the monthly volatility, look at the variations every day, get used to the volatility, gradually start increasing. When you systematically invest, but when you see some dip, force yourself to invest more, so you get used to that idea of the volatility even better, and then build it up over the next couple of years to 50 to 60% of equity exposure overall asset allocation. This is the most important point of getting used to it, because you don't know your risk appetite, and if you suddenly start investing 60% of your money from day one, and tomorrow you immediately see a crash, you may not be able to emotionally handle it. So gradually get used to the volatility and stop worrying about products from day one. It doesn't matter where you invest. The first thing is where how used to you are in terms of volatility. When I say it doesn't matter where you invest, what I mean is, among equity oriented funds, it doesn't matter if you're if you don't appreciate volatility. That's what I mean. So get used to it, and then you can always fine tune your portfolio. Most people, including me, we have started investing and then slowly learned on the fly. So there are many aspects to learn on the fly, but don't tell yourself that without any proof that your risk appetite is this much high or medium or low. Don't tell yourself without any data. That's the singular point I want to make put across in this video. Catch you later. Bye bye.